Hi, and welcome to Futures Discovery on John Lothian News. I'm your host, Corties Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're immersing ourselves in a pivotal episode focused on Algorithmic Adventures, navigating the world of order book matching strategies in futures trading. This episode is about deciphering the dynamic landscape of financial trading. Join us as we delve into the intricacies of reading your order book as a professional in the futures market and unraveling the secrets behind successful order book matching strategies. In this episode, we're peeling back the layers of order book algorithms that drive modern futures trading. These algorithms are not just tools, they're intricate engines shaping the landscape of financial markets. From fundamental limit orders, allowing traders to specify their desired trading price, to swift executions of market orders at prevailing market prices. These are building blocks of sophisticated trading strategies. We'll take a quantitative look at some of the fundamental order book matching strategies implemented within the futures market. First, we'll look at FIFO, which stands for first in, first out. This means that the oldest order on your order book, or the first one that you place, will be executed first when the market participant on the other side of your trade places their order, hence first in, first out. We'll also take a look at pro rata. Pro rata is a strategy that focuses on the ratio of your order towards the entire order on the order book, and your order gets executed as that ratio quantity. Don't worry, we'll take an in-depth look as a quantitative perspective, looking at both of these strategies that are implemented within the futures market. But it doesn't stop there. We'll delve into the strategic realm of VWAP, or volume weighted average price. This algorithm seeks to achieve the average price by considering trading volume at different price levels. This sophisticated approach is employed by many institutional traders to minimize market impact. And then there's the thrilling world of sniping algorithms. Imagine rapid-fire, precision trading in the final moments before market closes. It's a high-stakes game that's designed to capitalize on last-second price movements. Its strategy demands not only speed, but strategic finesse. However, as with any powerful tool, there are challenges to consider. We'll be addressing concerns about market manipulation, transparency issues, and the ever-present risk of market crashes. It's essential to understand the potential pitfalls that come with the use of these powerful algorithms. By the end of this episode, you'll not only understand the basics, but you'll be armed with the insights into the strategic and sometimes treacherous world of the algorithmic adventures. This is just a brief overview of the world of order book matching strategies in futures trading. To obtain a more insightful perspective on this mathematical aspect of futures markets, let's engage with a conversation with Brian Peterson. Brian wears multiple hats as the owner of Wendy Financials and a managing member of Bray Rock Investments. He is also an adjunct professor at the University of Illinois at Urbana-Champaign, where he's the creator and instructor of multiple algorithmic trading courses. With an extensive background and expertise in the financial futures industry, Brian is a seasoned professional who brings a wealth of experience to our conversation of order book matching algorithms. Brian, thanks for being with us today.
Thanks for having me.
Of course. Can you provide an overview of how order book matching algorithms function in the context of the future space?
Most major exchanges globally are what's defined as a central limit order book, or CLOB. So the central limit order book is created by all sorts of market participants putting their limit orders into the market. So they put in a market for a certain quantity at a certain price, and if that price doesn't cross what's called the bid-ask spread, it gets rested in the book. So these are called resting orders in the book. And so the way that the order book is put together is this central limit order book. Now, when an order crosses the bid-ask spread, there's a matching algorithm that the exchange will use to decide how to fill the participants on the other side that are resting at the price that the new order is going to match at.
Could you just elaborate what a limit order and a market order is and why people use them in different contexts?
Yeah, so a market order We'll start with that. That's the one that most people would use. If you go onto your online brokerage and you say you want to trade something, what's going to happen is that sends an order, what's called at the market, which is why it's called a market order. And what will happen at that point is your order will actually be directed to cross the bid-ask spread. So if you're buying, you cross the spread to the people who are offering to sell. And if you're selling, you cross the spread for people who are bidding to buy, and then it will match in the matching engine for that. A limit order is saying the same thing. I'm going to either make an offer to sell or I'm going to bid to buy. That's where those words come from. And that I'm going to make that offer to sell at a limit price. I'm going to make that bid to buy at a limit price. There are, of course, other variations on order types, iceberg orders, hidden orders, that are all variations on a limit order at the end of the day, where they have a limit price and then they have extra rules about how they interact with the order book.
Great. And so as I understand that, it seems like the market order is something that's really just quick to interact within the market, that's taking what the market takes you for whatever price it's at, where limit orders and more specialized orders are you're looking for a specific price or a set of rules before you enter the market. Does that sound kind of right in the sense of market and limit orders?
That's right. And the other thing to be aware of is that professional participants at least pay less for limit orders than they do for market orders. So you're both paying less spread and you're often paying less fees as well, whether that's commissions or exchange fees. It's often cheaper to do limit orders than it is to do market orders for professional participants. Now, of course, if you're a retail participant, you're trading on Robinhood or your Fidelity account or Schwab account or whatever, it's usually the opposite. They usually encourage you to do market orders because they make more money when you do a market order.
A little harder for retail traders starting off on both sides, but it's nice to hear that perspective and understanding like how market moves around and what you're paying for when you're interacting in these markets. And so moving on to more specific algorithms, how does a VWAP or a volume weighted average price contribute to achieving an average price in futures trading?
A lot of times a large customer will use what are often called broker algorithms or bank algorithms to trade because your broker or your bank will make those algorithms available to you. These fall into a variety of different classes, but probably the two most common ones are three, I guess. The three most common types are a TWAP order, a time-weighted average price, a VWAP order, which is a volume-weighted average price, and a percent of volume order. So if you want to trade right now, because you believe that you have the best price right now, you should just go trade, whether with a limit order or with a market order. If, however, you don't have a strong view about the price and you've got a large order, again, if it's a small order, if it's $100 or $1,000, it doesn't matter. But if you've got a large order, it makes the most, and you don't have an exact view on, right now, right this instant is the best price to trade at, then it makes a lot of sense for you to spread that whole order, your big order, out over time. And so these broker algos or bank algos, or they sometimes called canned algorithms, allow you to do that by participating in the market using some benchmark. So I'll break it up. I'll work backwards. The percentage of volume order is exactly what it sounds like. It's an order which attempts to have your order participate at a certain percentage of the overall market's volume. So if you're huge, if you're a Fidelity or somebody like that, and you're moving money around as part of a fund buy or a fund sell, you can't just go to the market and slap the market for all of it. You have to back up and think a little bit about what your execution is going to look like and how you're going to do that. And so you're going to spread that out. You're going to spread that out algorithmically over time. So percent of volume order says just work at 0.5% or 0.25% or even sometimes up. We've seen percent of volume orders up to 8 or 9% of the total market volume, and try to limit your market impact. A time-weighted average price is just what it sounds like. It's using a time clock, like a metronome, to make decisions about when to trade and how much to trade in each time slice. And a volume-weighted average price changes that metronome. It changes the metronome from a time metronome, tick, 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 to a volume metronome, where now what you're looking at is how much volume goes through, and you're saying, oh, well, 100 contracts or 1,000 contracts is the volume clock that we want to use in which to benchmark our execution and spread our execution out over time.
You got so much money moving around that you want to spread this out so you're not really tanking the market or killing the market at any one time. And so I was also interested into sniping algorithms, something we touched briefly on in the episode as well. Can you share your insights into the world of sniping algorithms and how they operate in the final moments before market closure?
There is no formal definition of sniping algorithms, but sniping algorithms have been around for about 20 years, maybe 25 years. And the general idea is that if you've got an idea about what price you want to execute at, but you don't want to show your hand, you want to be a poker player and you don't want to show your hand to the market by using a resting limit order in the market, you wait until the price is where you want it to be and then you go try to grab it. So if anybody else shows their hand at the price you want, you go grab it, right? And so the broad class of sniping algorithms are about, having some price target, having some willingness to just go hit the market with a market order when you need it, or with what's called an executable or crossing limit order. So you can use a limit order that crosses the market. So it won't execute at the market price, but it crosses the bid-ask spread and still limits the maximum price you'll pay, or get paid if you're selling. But it doesn't. But it won't just trade at any price that's available. It'll only trade at that specific price. You also get into, with sniping algorithms, one of those other order variation types, which are called fill or kill or immediate or cancel orders, where they, again, just exactly what they sound like. An immediate or cancel order is do the whole thing or cancel it. A fill or kill is fill as much as you can or kill the rest. So sniper algorithms are typically written to use those kinds of specialized order types because you don't want to trade if you don't get the exact price that you want. Now, the other half of your question was the final moments before market closure. There's two parts of that. One of them is the part of it from the standpoint of a professional market participant who has a large position. They are usually trading in the final moments before the market closes because in most markets, including at the CME in Chicago, the last 30 seconds before settlement is when the settlement price is actually set. So there's a ton of trading back and forth in the settlement period as the professional market participants are trying to be on one side or the other of the settlement price. In other places, like if you're not going to get your book marked to settle, in some markets there's something called a closing auction or an opening auction, and you can participate in the closing auction or the opening auction. In futures markets, there is no opening auction or closing auction. There's just an opening match. So in the opening of the market, there's there's again a 30-second period when the designated market makers can't cancel. It's called the no cancel period, 30 seconds before the market opens. And so any resting orders that are there can get taken out in the opening match because no resting orders can get canceled. So you can put in orders to cross the market for that displayed liquidity in the opening of the market. And in the closing of the market, futures markets just close, but most futures markets settle earlier in the day. So for example, the S&P actually settles 15 minutes before the market closes. So the actually really important time is that settlement period, 15 minutes before the market closes. For oil, it's hours before the market closes. For grain, it's several hours before the market closes. So the market actually stays open after the settle, but there's a lot less volume. It's just people still needing to get stuff done before the end of their day, or they want to get flat and go home with no positions, or they need to hedge something before they're done for the day. But in futures markets, it's typically a 30-minute settlement period. So people will be, running sniping algorithms to try to get advantageous prices if they can going into that period, especially if they're also monitoring what price things are going to settle at. So that's where this kind of fits in. So that's sniping algorithms more general, and sniping algorithms in that settlement period right before the market describes a settlement price.
Have you traded markets with FIFO or pro rata algorithms? And if so, can you elaborate on what those algorithms are and what strategies they entail?
Most central limit order books are what's called FIFO, first in, first out. It's an acronym, means first in, first out. So that means that at any given price, there's a queue of resting limit orders there based on the time that those limit orders were put in. So that means that the first one to get to that price will be the first one in line, and they'll get filled first before somebody else gets filled behind them in line. It's very, very important to understand your queue position, to manage your queue position, to cancel orders if you don't want to be there, maybe to move to the back of the line. So there's all sorts of strategy around handling your queue position in a FIFO market. A pro rata market turns up in markets that are very, very large. The most common example is interest rate market. And pro rata markets mean that you get filled as a percentage of how much size you're showing on the book. So you get a pro rata allocation, just like the name says, from based on the size that you have in the book. So if there's 50,000 contracts there and you put a one lot in as a small trader, you probably will never get filled. Or you'll get filled only very, very infrequently. So what ends up happening is that the remainder, the rounding errors at the end of big orders get handed out to those one lots in a FIFO way at the end of the day. So, these big markets, because they move so slowly, again, the Fed announced that they weren't going to change interest rates probably in March. They might not change them till June. They might not even change them then. Well, that means we kind of know what short-term interest rates are, right? So that means that any movement in markets is going to be small around this very, very tight band because we know where the Fed is at. In markets like that, what the CME and other futures markets have chosen to do is they've chosen to use a pro rata allocation because otherwise it'd be very hard to get filled without crossing the bid-ask spread. So that's why you see pro rata markets, especially in these really large interest rate markets.
Can you talk about some of the nuances of different matching algorithms and what implications they have for market participants acting as market makers or market takers?
First, there are two kinds of market makers. There are designated market makers and there are what we'll call voluntary market makers. So there are people who have a designated market maker has an obligation to make a market. So they've got a contract with the exchange. They're probably a member of the exchange, and they've got a contract that says for these products, we are going to be here every day, 24 hours a day or 23 hours a day. The CME's open 23 hours a day. So, 23 hours a day, we're going to be here and we're going to make markets under these specific conditions. So we're going to show a certain amount of size, we're going to show a certain amount of width. So those types of agreements create an obligation on the market maker to manage their how much they show and how much they're trading because they promised. They signed a contract that promised. Voluntary market makers don't have any of those obligations. They can walk away at any time. They choose to make markets because they can make money doing it. And the biggest markets don't have necessarily designated market makers, but they often have incentive programs. So they may have incentives that, instead of creating obligations for designated market makers, they may create incentive programs for big market makers to say, hey, we've got a pool of $500,000 a month that we're going to pay to the biggest market makers. You just have to do this. Or they have to say, if you get a volume above this, we start giving you rebates. For example, there are interest rate strips. There are these big complex contracts that put together a whole bunch of durations of interest rates. They're not super liquid. They're really hard to trade. So the market incents trading firms to create a market there, to put resting limit orders on these strips of these big spread contracts, or double fly contracts in futures often have incentive programs. Same thing. It's a double fly is a combination of 4 durations stuck together, where you've got a mixture of longs and shorts in a ratio. So there are exchange listed double flies, double butterflies. So the market creates certain incentives for market makers to trade these things. So if you're one of those market makers, now I've got to manage all that. I've got to make sure I'm showing the right size. I've got to make sure I've got the right time in market. I've got to make sure my message rate is correct. Like if you send too many messages, the market will turn you off. If you don't send enough messages, you're violating your contract. So you've got all these decisions you've got to make in terms of managing that. Now, queue position comes into this in any FIFO market because I may want to, in a slower market, build queue position off the market But then if it gets closer to that price and I don't want that price, I have to back up. I have to go to the back of the line. I have to leave that price entirely. So these are all the kinds of decisions that you see with any big market maker who's running algorithmic market making in a futures market or an equity market, but we're talking about futures. So
I can think of how the market can be pushed or the price can be pushed around a little bit. How do you address concerns about market manipulation associated with these algorithms?
So first of all, market manipulation is illegal. That doesn't mean people don't try. A neutral market maker should be making a market around a fair price. In the old days, when you would have a market maker on the floor, you would walk up to them and you would say, make me a market. Tell me what price you're willing to buy at and what price you're willing to sell at. And so the market maker, who's presumed to be an informed participant in the market, should be offering a bid to buy and an offer to sell around their idea of the fair price. And so that means that, again, a neutral market maker will have a model for the fair price based on maybe macroeconomic data and based on maybe other instruments. And they'll then build a market around that's based on their liquidity, their costs to carry a position, and then as you build up a position, it's going to be also based on your position. So as a market maker gains a position, they're now going to have what's called an axe to grind. So if you've got an axe, you've got to grind your axe, which means that if I've got too much, if I've sold too much, I've got to buy some back, right? If I bought too much, I've got to sell it out. So now I'm going to be leaning on one side of the market. So there are all these terms that you'll hear, you'll see in books, and they all make sense when you really unpack them a little bit and understand where they came from. Now, when we get into market manipulation, what'll happen is that market manipulators are typically either trading at prices that they don't think are fair prices, or they're showing bids or offers at prices in order to trick the market into doing something. If you're showing bids and offers, this is called spoofing. You're spoofing the market with fake orders. If you're trading the market at unfair prices, there's all sorts of different names for that. Citadel got in trouble for this a while back. So lots of big firms have gotten in trouble for this, where you're actually like pushing the market, say, into the close or into the settle at a price that doesn't actually make sense because you want to cram the close, or you want to push into the market to try to make it, move the price. As far as, responding to those types of things, again, professional market participants should be paying attention to what's going on. If volume suddenly spikes in one part of the curve and nowhere else in the curve, you're like, well, what's going on? Is this a real order? Is this, BlackRock coming in because they've got to do something for a giant fund? Or is this, a runaway algo, because sometimes you see that too? Or is it something else entirely that's trying to, push the curve out of shape and pull the rest of it along with it? All sorts of monitoring and decision points that come into this, just to make sure stuff like that doesn't happen, or that you don't respond to it in ways that make you lose a lot of money.
How do you approach risk management in algorithmic trading? And are there specific strategies or precautions you take to mitigate potential pitfalls associated with algorithmic trading?
With algos, some of the biggest potential problems are that you send too many messages, you have a runaway algo, it trades too much. So that all comes down to limits on how many messages it can send in a second, limits on your total position, limits on price movement. If price moves more than 1%, you're out. As you start getting into bigger systems where you're really trading a portfolio, again, like I said, most market makers in futures are trading across the entire curve, all the durations, or at least all the liquid duration. So certainly the first entire year, often the first year and the second year, sometimes out, as much as a decade or more. So if we're talking about crude oil, for example, the first, say, 14 months are liquid, and then every 6 months, Junes and Decembers, out through about a decade. What you're really trying to do from a risk management perspective is you're trying to make sure that your whole position overall either reflects the view that you have. So if you've got a certain view on prices over the longer term, you may tilt your position to reflect a certain view, or you're going to be constantly leaning into as being as hedged as possible. So you don't really care where you trade in the curve, as long as you're using a covariance matrix and other things like that. I mean, covariance matrix is the simplest one, the simplest measure of risk of a portfolio, right? If you think about standard portfolio theory. So as long as you're trying to have your algorithms minimize the overall covariance of the portfolio, you're limiting your risk.
a lot of traders are looking and then participating over a curve, a longer duration. They're over a multitude of different expiration dates and contracts, and so it's a curve that they're really trading. And to hedge this risk, they're using a multitude of algorithms and mindsets to make sure that they have the right outlook that they want to portray into the market, or using good risk management tactics to make sure that everything's hedged out. And so, are there any emerging trends or technologies in algorithmic trading that you find particularly noteworthy? I know there's been a lot of advancement in the financial industry over the last couple decades, but is there anything upcoming now that is noteworthy to you?
I think one of the things that I've seen over the last several years is that we're seeing tools that used to be too expensive for smaller firms to use become more accessible. So one example, for example, would be an FPGA. FPGAs are field programmable gate arrays. They're very, very fast. Every ultra low latency firm is using FPGAs to trade. Now, FPGA engineers are really expensive. FPGA boards cost hundreds of thousands of dollars. So most small firms can't use them, right? They're just too expensive to program. All the big firms have, groups of specialists who only do that kind of work. However, what you see now over just the last few years is you see vendors starting to offer pre-built FPGA algorithms that you can run on smaller, older FPGAs that only cost, a few $1,000s rather than $150,000. Can't do all the things that you could do if you had an FPGA programmer on your staff. You can't do all the things that you could do if you had one of these $150,000 boards. But with a much smaller investment, several $1,000s, with software like we were talking about traders trading different sides of the trade, right? This is often done with a spread trade, where you're buying one leg and you're selling the other leg to get the spread on at the price you want. Well, there are software spreaders. Trading Technologies is probably the biggest futures platform that most retail, or what I would call, pro consumers, smaller pros would use, so they have a software spreader. Well, hardware spreaders are typically written in using an FPGA. So now you can start getting to this point where you start seeing these things. Another emerging trend that we'll talk about a little bit, obviously AI is all the big hype right now. Most AI models don't work for finance. I teach this stuff. I've been doing this stuff for decades. I've been using machine learning. We use machine learning models all the time. We don't use them to try to predict the price 2 minutes from now. So we use them to create indicators. We use them to create features. We use them to maybe help us generate signals. We don't try to build the one model to rule them all and have ChatGPT tell me what I should be doing tomorrow. That's a horrible, horrible idea. But we will continue to see machine learning models and AI models have a deeper and deeper impact on financial markets, just not in the way that the hype machine is kind of pushing out there, because these models are just bigger and more complex than that, and they take a lot more work to get the results that you want.
And so our viewers at home that are new to algorithmic trading, what particular advice would you offer for them navigating the complexities of order book matching strategies in the future space?
Well, I think from an order book matching perspective, I think the first thing you've got to decide is, are you going to be a passive market participant? Are you going to be resting on the order book and waiting because you've got an idea of what the right price is? At which point it's probably best to use limit orders or variations on limit orders at the price that you think is the right price. So your model gives you the right price, you put your order in at that price, and if the market gets there, great. If not, the market missed out because you knew what the right price was. If however, your goal is to jump onto a trend, are you going to be a more active participant? Are you going to cross the bid-ask spread? Or are you going to cross the bid-ask spread to hedge? So, from an order matching perspective, the decision of whether or not to cross should be mostly based on whether you have a view on the price or a view on the price direction. And of course, cost comes into this as well as you get bigger, as we talked about at the very beginning. One of the other things I would say for people that are new to algorithmic trading, if you're thinking about getting into algorithmic trading, is focus really, really hard on your features and indicators. What is it that you're using to figure out your edge? Because if you've got good features, lots and lots of models can make money. If you've got bad features, garbage in, garbage out. So, what I tell my teams, what I tell my students is that you should spend the vast majority of your time working on building those features or those indicators or those signal processes and testing those completely independently of the quote unquote trading logic. Because, if I've got good indicators, if I've got a good idea of where the price is going to evolve or how risk is going to evolve, lots of different ways of trading that model can make money.
All great things to focus on, and I appreciate that. And then one more thing, as we get ready to wrap up here, you've had a lot of experience in the industry, coming from the physics side, making your way into the financial side, and then now you're teaching as well. What are some key takeaways over all, your entire career that you'd like to give the audience regarding the algorithmic adventures we've been talking about today?
30 years ago, most trading in futures happened on the floor. It was a bunch of people who all knew each other, who all showed up at the same time every day, and they yelled at each other for 6 hours. And some client orders facing into that and some not. The floors are basically gone. I mean, there are still floors for specific products, but the floors are basically gone. The computers are doing the trading. So I think that for anybody who's new to trading, you need to think about what sorts of quantitative models are you going to use to inform your trading. Now, that could be a straight up portfolio model where all you're doing is saying, I'm going to have a portfolio and I'm going to minimize my overall portfolio risk. Or it could be a super sophisticated, ultra low latency, machine learning model. But somewhere there's got to be a model, because today computers trade far more than people do today. And so, anybody who's coming into this industry as a trader, even if you're going to be sitting at home and clicking away on a screen from your house, you need to be thinking about what's your edge, how do you get that edge, how do you keep that edge, and that all comes down to what are you going to do to model it.
Well, I think that's great perspective. We talked about some of the advances in the financial industry, especially with technology. And as a trader or someone just getting into the industry as a algorithmic side or just learning about different derivative markets, having that quantitative modeling aspect or, thought process in the back of your head is going to be important with the advancements in the direction it seems like the industry is going. So that's great insight. And I appreciate all your answers today and your time and insights into the intricate world of order book matching algorithms. Your experience and expertise provide valuable perspective as we navigate the complexities of financial futures. Thank you for being a part of Futures Discovery today, Brian. Thank you.
Thank you, Cortez.
If you like the content on Futures Discovery and you want to learn more about derivative markets as a whole, go check out Options Discovery, hosted by ESMA, to learn more about financial markets. And for a deep dive into order book matching algorithms, check out our walkthrough linked in the description.